Okay, so we stopped in previous session here, classification of financial assets. We said that there are three types in financial assets. Like under IS 39, there were four. Under IFRS 9, the new standard, you've got three types of financial assets. You call them amortized cost. You call them fair value through OCI. We call it FVOCI, fair value through other comprehensive income. And we said fair value through profit and loss, FVTPL, which means that on the balance sheet, we will show the fair value. Any gains and losses will be recognized in OCI. On the balance sheet, we show it at fair value. Any gains and losses will be recognized in profit and loss. And I told you in the last session that in amortized cost, this is the valuation. This goes to SOFP. And I asked a question that if there are any gains and losses, where do they go? So generally, there are no gains and losses. Generally, under normal situation, there are no gains and losses in amortized cost. Gains and losses will happen only when you do a remeasurement because of some changes in the discount rates. Because you remember that amortized cost, how did we calculate? We calculated amortized cost by discounting the future value, converting it into present value, and then adding on the top accrued interest, subtracting the interest payment. You remember that Excel file we worked together. So we used a discount rate. If that's for some reason that discount rate changes, if the discount rate changes and then you need to remeasure your present value, of course, in such a situation, you might have gains and losses on amortized cost as well. And you take them to P&L then. And then you've got here, maybe you de-recognize the asset. If you de-recognize, which means when you remove, and at the time of de-recognition, again, there is any change in measurement, then gains and losses will happen. Otherwise, there are not. Okay, classification basis. Now, how do we know that which asset we should write down in amortized cost, which asset we should put in fair value through OCI, which should go to fair value through P&L? I will first explain you the rules which have been given by the standard IFRS 9. And then I will explain you the logic, the rationale, the reasoning behind those rules. Okay. So not just like, okay, you have to remember it, but we have to understand it. So what are the actually, so what they do, there are two standards, there are two criterias, there are two conditions which we need to see. What are those two conditions? IFRS 9 classification is made on the basis of both. Both means that there are two conditions. Number one is called entity's business model. Now, this is where I said that, you know, if you remember IS 39, I told you that some of these information you need to apply in IFRS 9 as well. And that's why I explained here. There were four of them. One was called HTM, and one was called, which is held to maturity, and one was held for trading. So this is the which will tell you this is your business model. Business model means that when an entity purchases or becomes party to that financial instrument, what are their intentions? What do they do usually? What is the business model? I mean, do you keep these such type of financial instruments for until maturity, or do you keep them for the trading purposes? For example, I'm a trading house, I'm a broker. I buy a lot of bonds, a lot of, you know, different types of financial instruments, but I don't intend to keep them. I'm just keeping, I'm on a speculation thing. Okay. So I keep on watching the market. As soon as the market goes up or it becomes beneficial, I sell it. You are a different entity. You are an insurance company. And you have some part of your portfolio, you have invested in certain bonds. You don't trade them on daily basis, and you don't have any intention of trading them. You have only intention of collecting the cash flows. We call it collect the contractual cash flows. Contractual cash flow. So What is your business model? Is your business model is to collect the contractual cash flow? When you say that my business model is to collect contractual cash flow, it means you are talking about held to maturity, because you say I will collect in, this is a bond which has 5 years life. I will collect $5, $5, $5, $5, $5, and $100. So I have an intention of collecting the cash flow. And when I say collecting, it means collecting to the end. This means held to maturity. So first criteria is we see that what does this business do? And I will explain you how it will work. But first you understand that there are two options. Either you are investing here or buying this instrument to keep it until the end, or you want to sell it anytime. This is the first thing. The second thing is the contractual cash flow nature. What does this instrument gives? Does it give contractual cash flow? And contractual cash flow, we call it SPPI. SPPI. SPPI solely payments of principal and interest. Solely means only. Only payments of principal and interest. Remember that particular bond for 5 years? What does it give? It gives 5, 5, 5, 5, and 110, 115. Nothing more, nothing less. If you go there and they say, you know, we cannot give you $5, please take $4. The market has gone up, market has gone down, nothing. It's a contractual cash flow. And that contractual cash flow, it consists of payments of principal and interest. You will only receive this. You wouldn't receive $1 more or $1 less. It's not about market price. It's about 5, 5, 5, 5, and 115. So SPPI criteria, I call it. So if any financial instrument, it meets the SPPI criteria, and I actually would see first, I prefer to see SPPI first, and then I see the second one. Anyways, so you see what is your business model, and then whether this financial instrument, it meets SPPI criteria or not. For example, I tell you, let's suppose there's a thing which is called ordinary share. Ordinary share in our UK language, which is in US language, you call it common stock, or you call it equity share. Equity share gives you what? It gives you dividend. When? Every year. Maybe yes, maybe no. And the market price goes up and goes down. So ordinary share, it fails on SPPI criteria because dividends are not fixed amounts. Sometimes the company gives more dividend, sometimes they give less dividend, and sometimes they don't give it at all. So shares do not meet on SPPI criteria. Yes, bonds, they meet SPPI criteria because bonds have a fixed coupon rate, 5% or 6%. So this is, I'm just trying to tell you that SPPI criteria, when it is not met. In ordinary shares, it is not met. Then I said held to maturity, which means keeping the instrument until the end. Your business model is to keep the instrument until to the last day, or are you going to sell it in between? Shares, ordinary shares, equity shares, they also do not meet the HTM criteria. They don't meet to HTM criteria because shares do not have a life. Shares, there is no last day of the instrument. There is no exercise date for the share. Shares, they have a perpetual life. So when I say held to maturity, I say held to maturity, which means the exercise date. Shares do not have a maturity date. So your equity shares, they do not meet the first criteria and they do not meet the second criteria. Then you talk about bonds. A bond which is 5 years. This bond, it meets the contractual because it has SPPI and It meets this criteria of SPPI as opposed to equity shares. But again, somebody will like to keep it to maturity. For example, I am keeping it to maturity, and maybe Rajesh is saying that I'm keeping it for trading purposes. So again, the classification differs. Although this bond, it does meet the SPPI criteria, but then two of us, I and maybe Janish or maybe Joseph and I, we have different approaches. My business model is that I keep it until the end, and Joseph's business model is that he will sell it whenever the market is favorable. So you need to see these two criteria, and everything will become very simple. So amortized cost, what is amortized cost? If you remember the three classifications we had, the first one was amortized cost. So which financial instruments are you going to show under amortized cost? You will show under amortized cost those ones. Okay, by the way, this is the definition of amortized cost. It's so complex. It's written in a very complex manner. I already have explained you amortized cost with the help of the one Excel sheet and all the calculation. So amortized cost is what? Amortized cost is, let me just pull it off. And then amortized cost is of a financial asset or financial liability is, so amortized cost could be for financial asset or for financial liability, as I explained you, that this is the amount at which the financial asset or liability is measured at initial recognition, which means the present value, minus the principal payments, if you have made any, plus or minus the cumulative amortization of any difference between that initial amount and the maturity amount, and minus any written down or impairment or uncollectability. So these are mostly, they're talking about changes in the principal. In general, you should remember that amortized cost should be a present value plus accrued interest which you will calculate at, remember, effective interest rate 7%, 8%, minus the coupon payments. Coupon payments probably were 5% or 6%. This is the general thing. These things are actually about valuation of this thing, because it is possible that interest rate they change, so this value you might change. So, and there could be any impairment, so you may adjust it for impairment as well. But basically, the logic is this one. The others are changes in the valuation. So amortized cost anyways. So what comes on amortized cost? Amortized cost, the first category, you will write down any financial instrument which meets these two criteria. Number one, that the particular instrument, it meets the SPPI criteria. And number two, it is held within business whose objective is to help financial assets to collect contractual cash flows. Collect means HTM, held to maturity. Collect means that I am keeping it and I will collect my $5, $5, $5, $5, and like this. So this is actually held to maturity. So if you have a bond which gives a fixed 5 or 6%, and you want to keep the bond until the end, which means until the maturity, then this bond should be shown in your financial statements at amortized cost. But if you intend to sell the bond anytime in between, then you cannot show it on the balance sheet at amortized cost. Now, why they make this rule, I will explain you. Let me first explain, and then I'll come back and say that why do we make this rule, the logic, the rationale. Second criteria, we said FVOCI, fair value through other comprehensive income. It again meets the SPPI criteria. So SPPI criteria is again met, which means 5, 5, 5, 5, 5, and 15, solely payments of principal and interest. Whatever has been agreed on the contract, you will only get that, not anything more, not anything less. And number two is held in a business whose business model is in which assets are managed to manage both in order to collect contractual cash flows and for sale. So you have two options. You say either I will keep it or I will sell it. Both options are available. Maybe if the market becomes attractive or if I need liquidity, I will sell it. Otherwise, I will keep it. I have both options open. They come to fair value through OCI. Fair value through OCI. Okay. Now, and all other things, whatever is left, all other things, they go to fair value through P&L. So all other financial assets, which do not come on the first and the second category, they go to fair value through P&L. So let's speak about your ordinary shares. If I speak ordinary shares, they come here because ordinary shares, they fail on SPPI. They don't have fixed principles and fixed interest payments. They fail in here. Now, first I will go back and I will explain you that why do we put these two things here. See, a similar bond, a same bond. This is a bond. Let's give the name of the bond. Let's call it alpha. This bond is for 5 years and it gives 6% interest rates. And there are two parties, A, and one party is B. A says, I'm going to keep it for held to maturity. I'm buying this bond, but I will keep this bond whenever until I can, until the last day. I will collect all of the interest and I will collect my principal. So because this bond, it meets the SPPI criteria, I can see SPPI from here and I see HTM. I say that A should show this bond in its financial statements at amortized cost. And then I asked B, what are your intentions? He said it could be HTM or it could be trading. I might keep it or I might sell it. Now the bond is same, but we will put it at fair value through OCI. It is the same bond. It is the same instrument. Just by asking their intention, just by asking their business model, we are putting them and we are giving them two different valuation because it will take the amortized cost, which is, entity specific valuation. This is our internal calculation. And he is going to make it on market specific valuation, the market value. And the reason is very clear. The reason is very clear. Why do we do so? Because if you consider this party A, who says that I am going to keep it until the end. So my brother, if you want to keep it until the end, you are not interested in market value. You are not selling it. Why should you be talking about the market value? Are you selling it? You are not selling it. So whether the market goes up or the market goes down, it doesn't bother you because you will collect your 5 and in the last year you will collect your 115. Market might go up, might go down. I am not bothered by the market because I am not going to sell it into the market. That's why I want to show it at my amortized cost. And that makes perfect sense. But this guy, B, who says that I might sell it, when he says I might sell it, it means that he has an intention to sell. And if you want to sell something, what do you do every day? You check the market. Imagine you've got an apartment. You are living in that apartment. Do you check how much is the value of this apartment in the market every day or every week or every month? You don't, because you don't have any intention to sell. You are living there. But if you have an apartment for which you have an intention to sell, so where will you sell it? In the market. When you say that I might sell it, I'm not keeping it to the end. It is quite normal that you would be checking the market value of that thing very frequently, because as soon as the market looks favorable, you will sell it. So if you have this intention that I might be selling it, it means that you are talking about fair value. So you should be showing it on fair value. Does that make sense to you? Market specific.
Yes, sir.
Okay. So now the question comes that it is fair value. Now I understood the two things. Remember, I have amortized cost, I have fair value OCI, and I have fair value P&L. Now you understood exactly the difference between amortized cost and fair value thing. How do we classify? Why do we put it? But then you might say that, why do we have these two things, P&L and OCI? Maybe we make one category. We make amortized cost and we make fair value, maybe only one category. Why do we do fair value two categories? I understand that I have an intention to sell it, so I should be measuring it at fair value. So far, I understand. It makes sense. But then, what is the logic for putting it in OCI and P&L? Maybe there should be one category with fair value, one category with amortized cost, that's all. Why do we make two categories for fair value? Fair value, I understand. I need fair value because I want to sell it in market. So I should be doing it at fair value. Perfectly okay with me. But why do I have two of these? Why not one fair value? Maybe fair value through OCI, maybe fair value through P&L. Now you will remember that again, OCI and fair value through P&L. Now remember that if you go back to our initial discussion, what entities want, what managers want, managers usually are afraid of showing losses in P&L. Any transactions in P&L, they go and they affect them. In OCI, we put unrealized gains, unrealized losses, etc. So that logic will help you here now. That two categories you have, fair value through OCI, fair value through P&L. And you remember that we discussed it so many times and in so much detail, what goes to OCI, what goes to P&L. If it is unrealized, it goes to P&L. If it is manager's decision, it goes to P&L. And the same logic, we will use the same logic, but we will slightly adjust it according to our need in IFRS 9, but fundamental concept will remain the same. Now, let's suppose if we talk about, so we understand fair value through OCI. So two criteria is met. I want to keep it to the end and it gives me SPPI. This is amortized cost. It meets SPPI, but I might keep it to the end or might sell it now. It goes to fair value through OCI. And all other things which do not meet the first and the second, they go to fair value through P&L. So if I speak about my equity shares does not meet the first category because first category is SPPI and equity share fails on SPPI. Then if I talk about second category is also SPPI, which is fair value through OCI. Equity shares fail on amortized cost. It fails on the second category, FV OCI, because FV OCI also talk about SPPI. So equity share does not come here. So where does the equity share comes in? In the third category, which is fair value through P&L. So equity shares when you buy of some other entity. When you buy equity shares of some other entity, the default category, we call it the default category, is fair value through P&L. And actually that is a separate interesting topic or concept. We call it, let me just write it down. I should have been talking about it later, but because I started the discussion, so let's roll it up here. We call it irrevocable election for equity shares. So that is a separate concept, okay? So that's why what is this concept? The name of the thing is, and the name why I'm saying, because that name is important. You call it irrevocable election of equity shares. What does that mean? So there is a concept behind that. The concept, it says, what we understood from here, that your equity shares, if you buy not your own shares, equity shares of some other entity you purchase. If you purchase equity shares of some other entity, it should go to fair value through P&L. This is what we discussed. Because first and second category, amortized cost OCI, I can't put it because of SPPI condition. Equity share does not meet SPPI, so I'm going to put it in fair value through P&L. But then you get slightly afraid or scared that if I purchase, I've made investment of $5 million. I purchased shares of some company called X company. This is an investment which I have made. And the standard says, show it into fair value through P&L. Why does standard says that? Now, if you ask me, or if I ask you, why did you buy these shares? This was the money which belongs to shareholders. It was in your business. You take out money and you go and you buy shares in X company. So that is your decision. You are manager. And any gain or loss should be reflected in P&L. Just the same logic which we have talked before. As a manager, you made this decision. And the standard is very much fair. It says that show it in P&L. So far, that makes perfect sense, because this is what we discussed in past, that if manager's decision is there, it goes to P&L, gains and losses. If there is a gain, you take the credit. If there is a loss, you take the responsibility. Why did you make this investment? Put it in P&L. Makes sense. And also the standard says, put it in P&L. But then you might come in and you say that, you know what? These equity shares I purchased for long term. It is my investment for long term. I'm not going to sell them in a short period of time. So it means that the gains and losses, they might be going up, they might be going down. Whatever the gains and losses are happening, they are unrealized gains and losses. Unrealized, because I want to keep these shares for a long period of time. And the gains and losses current year, this year, price goes up, there is a loss, but next year price might goes up. Next year price may go up. Why should I put it in P&L? Because in P&L, the things are which are current year related. Profit and loss statement, it represents 1 year, the gains and losses for that year. But I want to keep it for a long term, and the gains and losses are unrealized. And you remember, unrealized items, we put it in OCI. So you came back with an argument. I gave an argument that it was your decision. I want to put it in P&L. This is what the standard says. You came up with another argument that, okay, fine, I understand. But then what do I do with this OCI thing? Because IFRS says unrealized items go to OCI. So please allow me to put it into OCI. When you as a manager come to me and say that I don't want to put it in P&L, I want to put it in OCI, I immediately understand where are you coming from? You don't want to take the risk with your profit and loss. You don't want to take the risk of your profit before interest and taxes, remember? Because if I put it in P&L, it becomes the operating part. And operating part, you have to take responsibility. You are answerable. So you are trying to shift this risk from P&L to OCI. You say to put it into OCI. I will put it into OCI. I say, fine. I know that. Why do you want to do that? And you have got an argument also for that unrealized thing. I agree with you. I give you this option, no problem. Put it into OCI, but it will be an irrevocable election. Irrevocable election, which means that you made a request to transfer it from P&L to OCI. I agreed with your request, take it down to OCI, but then you cannot reverse it. Tomorrow, when these shares will be sold, there will be some gain. That gain will be realized. You cannot take it to P&L. Remember, OCI items, when they are realized, which mean when they are converted, when you execute them, the gains are transferred from OCI to P&L. You call it, recycle. So you usually do recycling for that. You see, normally what happens that when you have an OCI, there are some gains which are shown in OCI, for example, revaluation gain. So as long as your property, when you revalue it, you make a gain, you put it in OCI because it is unrealized. But when you sell the property and then you call it gain on disposal, that you have actually realized that gain, you know how much it is because the transaction has been realized. Before it was going up, going down, going up, every year going down. Whenever you do revaluations, it remains in OCI. But when it is realized, it is transferred to P&L. It becomes part of other income. You have gross profit, below gross profit, you call it other income. So that is called recycling. Recycling of gains from OCI to P&L. This is normally a case. But in this special case, where I wanted to put it into P&L, you made a request to put it in OCI. I said, no problem, I will agree with you. These are equity shares. Logically, they should be in P&L because they do not meet SPPI criteria. But because you have one reason that it is unrealized, so I will allow you to put them into OCI. You can put them into OCI, but it is going to be an irrevocable election. Irrevocable election means that, number one, you will not transfer them back to P&L. You have chosen it like this, so let it be like this. And number two, the gains or losses on these shares, tomorrow you cannot transfer them to P&L. It is not possible that you see the risk and you say, put it in OCI. Tomorrow you make a gain. You say, please allow me to transfer the gain. So then you cannot take the credit on that as well. Do I make sense here?
So how it will present then, like if there is a gain?
That is equity part, not to P&L, equity part. I will not allow it to take it back to P&L. I will not allow to make you this thing that from OCI you transfer it to P&L.
See, for example, we purchased one equity shares, say like $50.
Right.
Next year there is an unrealized gain, and it is.
Now the first thing is when you purchase it, how did you classify it? The standard says says classify
if it is an irrevocable election,
so and we are in OCI.
Okay, it is in OCI. So the change is unrealized gains from 50 to 70. This 20 unrealized part, it will be in OCI. And the next year there is a the market value. You can say like it is in 80, and you are going to dispose this one.
You make realized gain now.
So that realized gain, the difference of 10, where it will show, it is not in P&L.
No, it is again not in P&L. Whatever is related to this share, it will remain in OCI, or it will be credited to equity. It will directly go to the balance sheet to the equity part where you make the gain.
Okay, so it will transfer to equity.
Yeah, directly. We will not allow it to remain in PL because the default category was fair value through P&L. You came in and you requested fair value through OCI. Equity shares, default category is this one, but you can put it here, but this is irrevocable election. Irrevocable election means that once you take them here, then all the gains and losses will remain here. They will not be transferred to P&L.
Okay, if it is in equity, at the end, it will be transferred to the retained earnings, right?
Yeah.
So the ultimate effect will be there, but that particular year profit
it should not come from the profit and loss. It should not, because your bonuses are calculated on P&L basis. I'm not going to give you reward for that. I'm not going to give you credit for that.
So it will not just for the assessment purpose only. We cannot consider into the P&L.
Yes.
But but for the benefit, it is actually routed to the shareholders itself.
So benefit will go to shareholders, whether you take it from here or you take it from there. Ultimately, what you put in P&L, that also ends up into equity.
Okay, the only condition is like if it is irrevocable. In that cases, so we can consider this as an OCI. Otherwise, it is in P&L.
See,
that is the only thing which we have.
That is the only thing. See, what you have through fair value through P&L, this also ends up into equity.
Yeah.
But it goes through profit and loss statement.
Yeah.
What you have in fair value through OCI, it will also go through equity, but it will not go through P&L.
Yeah. Understood.
So the question is whether you will reflect it in the P&L or not, basically.
Yeah, because listen, when I told you that equity shares, their default category is fair value P&L through P&L. You said that I don't want to put it here. I want an exception. So when you made an exception, I say you are talking about an exception. That exception will be irrevocable. Irrevocable means you cannot reverse it back. Okay, if I speak about receivables, what happens with receivables? So we have three criteria, we have three categories. Let me put them here: amortized cost and fair value through OCI and fair value through P&L. The criteria are HTM, or it was SPPI. Amortized cost, it meets SPPI. Fair value OCI, it meets SPPI. This is for HTM. This is HTM or other, or trading, whatever. And all others, they come in here. So if I talk about receivables, do they meet HTM criteria? Do you keep till the end and then collect money from the customer? Yes or no?
So can you repeat that?
If I have receivables, do receivable meet my SPPI criteria?
There is no solely payment of principal and interest.
So it meets because the contract says 25,000 receivable and the customer will give you 25,000 receivable. So it is solely payment of principal and interest. Principal is not there, but interest is there. So receivable, it meets the first criteria, SPPI. Does receivable meet HTM criteria also?
No, I have a doubt. How it is meeting the SPPI criteria in receivable? Is there any principal and interest portion in a receivable?
Yeah, if there is an interest, I would consider it. If there is no interest, I will not consider it. It does not mean that interest and principal both must be made there. Maybe there are some instrument, there is no interest, maybe there is an interest. And there could be an interest as well. Remember IFRS 15, if a customer has to pay you 100K in 1 year time, you discounted the present value, you say financing component. So 88,000 was the present value, this goes to revenue, and the remaining 12,000 was the financing component, remember?
Yeah.
So this is my receivable, what it includes inside.
Okay, clear.
So receivable, it meets SPPI criteria. There is a customer who has to pay me 25,000, but only after 3 months. So I'm not going to discount it. There is no financing component, but it is principal. When you say SPPI, principal and interest, you should think like nothing more, nothing less. Whatever is written on the document, that you will get. Contractual cash flow. You consider it as a contractual cash flow. In case of receivable, you do have a contractual cash flow because it has an invoice for 25,000. Customer cannot come in and say, I'm paying only 24,000. So receivable, they meet SPPI criteria, and receivable also meets HTM because it is for 30 days, 60 days, 90 days, 120 days, and you wait until that time. So receivables are in amortized cost. Bonds could be in amortized cost, Bond could be an OCI. Bond can be here or here, depending on your purpose. If you have taken a bank loan or given a bank loan, so let's suppose for a bank, when the banks, they give loan to a customer, what do bank expect from the customer? That he will pay the interest and he will pay the principal. So SPPI criteria is met in case of a bank giving loan. And then bank will wait until the end, because customer will make payments on monthly basis, 36 payments, 24 payments, whatever. So it meets the HTM criteria, it meets the SPPI criteria. Banks will show the loans also in AMC. Clear?
Yes.
Okay. So this is about financial assets. Next is classification of financial liabilities. Liabilities are, again, the only complication in liabilities would be when you have to distinguish between is it equity or is it liability. That is one area which becomes sometimes challenging. Otherwise, there are only two categories, and the two categories are same, which you are already familiar with financial assets. One is amortized cost, and the criteria is same. The two things, SPPI and held to maturity. Remember that thing, SPPI plus held to maturity. It goes to amortized cost. Every other thing goes to fair value through P&L. There is no OCI, because on a liability, there might be a loss or gain, whatever, that you take it to P&L. So two categories for financial liabilities. A financial liability is classified at fair value through profit or loss if it is held for trading, or upon initial recognition, it is designated at fair value through P&L. So held for trading, yeah, we know that if it is held for trading results, they go to P&L. That makes sense. Or if it is designated at fair value through P&L in the beginning. If it is not held for trading, if it is there to keep until the maturity, you take it to the amortized cost, because amortized cost means that held to maturity. So held to maturity comes in amortized cost, others they go to P&L. Derivatives are always measured at fair value through P&L. Yes, because derivatives are P&L item. You might keep a derivative until the end, which is the maturity, which is the exercise date, but they are always measured at P&L, because that was your operating decision to cut down the, to hedge against some losses and protect yourself against some losses. So that goes to P&L. And these classification rules are unchanged from those previously contained with IAS 39. It's the same. IFRS 9 did not change for financial liabilities.